Hi, in this lesson we're going to be talking about closing costs and closing statements. So let's talk about some of the typical closing costs that buyers and sellers incur. First of all, the origination fee on a loan. Since this is a loan cost, it's almost always paid for by the borrower. How about the ALTA title insurance policy? Remember, that's the lender's policy, and again, since it's connected to the loan, the borrower is usually the one who pays for it. How about the standard owner's policy or even the extended coverage owner's policy? Well, that's typically paid for by the seller to evidence to the buyer that they have clear title. And finally, the escrow fee. Here in Arizona, we use escrow, and most frequently that escrow fee is split between the buyer and seller, half and half. Remember, escrow is a neutral third party, so it's not a bad idea to have the escrow fee split between the parties. Now, we're going to be talking about different entries on the closing statement. And let's make some generalizations here about these entries. First of all, earnest money. As we'll see, and we're going to do a closing statement exercise, as we'll see, earnest money is always a credit to the buyer. Now remember, at closing, we're talking about what happens at the settlement table, at the closing table. And since the buyer has already deposited earnest money with the escrow company, that earnest money is going to be a credit to the buyer against the purchase price. How about a new loan that the buyer is getting? Well, this may seem counterintuitive, but that new loan amount is going to be a credit to the buyer. Now you're saying to yourself, now wait a minute, this is a loan that the buyer owes. Yes, but at closing, it reduces the amount of cash that the buyer has to bring to closing. So as a simple example, let's say we had a $100,000 purchase price and the borrower was going to get a loan of $80,000. How much cash would the buyer have to bring to the table if that was the only other item in the transaction? The buyer would have to bring $20,000 cash to the table. So that $80,000 loan is a credit to the buyer at closing. Of course, after closing, the buyer has to make payments to the lender, but we're focusing on the day of closing. So a new loan amount is always a credit to the buyer. How about a loan payoff? Well, a loan payoff is always going to be a charge to the seller. The seller has an existing loan on the property and is going to be paying that loan off. Therefore, it's going to be a charge to the seller. How about a seller carryback loan? Well, remember, this is a new loan, so any loan is always a credit to the buyer because of the fact it will reduce the cash the buyer has to bring to the closing. But a seller carryback loan will also be a charge to the seller because it reduces the cash that the seller will take home. The seller is going to take home some cash, but as far as the seller carryback loan is concerned, the seller is taking back paper, and that paper is coming home with him, and the buyer is going to make payments to the seller after closing on that loan. But at closing, that seller carryback loan is a credit to the buyer, a charge to the seller. How about security deposits? Now, this would be on a rental property, so think about this. A tenant has paid, let's say, a $1,000 security deposit to the owner of the property, who's now selling that property to you. So that security deposit, when you take over ownership of the property, that's money that if the property is in great shape when the lease is up, that the seller, the owner, is going to owe to the buyer. Since you are the new owner of the property, what's going to happen here is the full security deposit, the full $1,000, will be credited to the buyer and will be charged to the seller. So we, in essence, prorate that, but we don't change the amount because the full security deposit has to be transferred from the seller to the buyer. So we credit the buyer, charge the seller. How about taxes that are paid in arrears? In other words, that the seller hasn't paid yet. We will always credit the buyer and charge the seller for unpaid taxes. Water bills. Now, this may or may not be the case because you can usually get the water meter read basically on or about the day of closing. But since water is paid in arrears, we would also credit the buyer and charge the seller for an unpaid water bill. And fuel oil reserves. Now, here in southern Arizona, we certainly don't have fuel oil, and in most other areas of the state, I don't believe we have fuel oil, but we might have propane. And the seller, let's say, has filled up the tank of propane and is selling the property. And presuming the seller has paid for that propane, then we would charge the buyer and credit the seller, charging the buyer for the amount of propane that's in that tank. So those are some of the closing statement entries that you will run across. Now let's do an actual closing statement. And in your course material, you have a scenario. Let's read through this so we can make sure that we understand it together. So we've got a property that's sold under the following terms. The sales price is $100,000, earnest money $5,000. The buyer is going to get a new loan, a new first loan of $70,000, and the buyer is going to execute a second loan to the seller, that's a seller carryback, for $10,000. The seller's existing loan of $40,000 will be paid off. Unpaid annual taxes are $1,200 and will be prorated as of closing. The buyer is going to pay a 1% loan origination fee. The buyer is going to pay the ALTA policy fee of $283 and 1/2 of the $304 escrow fee. The seller's going to pay $648 for the owner's title policy and a 6.1% brokerage commission. Closing is going to take place August 31st. Prorations should be done based on a 360-day year, with the seller being charged for the day of closing. Question: how much cash will the buyer need to pay at closing, and will the seller receive at closing? So let's take a look at the actual closing statement, with the seller's debits, charges, and credits on the left side, and the buyer's debits and credits on the right-hand side. And the individual items are listed here in the center. So let's first take the sales price. Well, the property is sold for $100,000, and that's going to be a charge or a debit to the buyer. The buyer owes that, and it will be a credit to the seller. Secondly is the earnest money. $5,000 earnest money has been given to the buyer, let's say weeks or months ago, when the escrow was opened, and here it is at closing. So the buyer gets credited for that $5,000. Now, what happens to the $5,000 on the seller side? Well, the answer is nothing. It doesn't appear there because it's already part of the $100,000 price. So the earnest money becomes a credit to the buyer, but it doesn't appear on the seller's side of the statement. Next one is the new loan, the new first loan. So as I mentioned, all new loans are always a credit to the buyer. So that $70,000 loan is a credit to the buyer because it reduces the cash the buyer has to bring to closing. How about on the seller side? Again, it doesn't appear because the seller's got all his or her money in that $100,000 purchase or sales price. How about the seller carryback loan? Well, that's $10,000, and like all loans, that will be a credit to the buyer. But how about the seller side? Well, now it is going to affect the seller side because it's less cash the seller will take home. So this loan that the seller is making to the buyer is a charge to the seller. In other words, if all we had was the $100,000 credit on the seller side for the sales price, and the seller was lending the buyer $10,000, the seller would take home $90,000 cash and have this $10,000 note that the buyer will pay on for the next few years. The next item is the payoff of the first loan. And since the seller owes that, it will reduce the seller's cash to take home. So we charge the seller $40,000. And of course, that does not appear on the buyer's side of the closing statement. So the next one is the tax proration. Now, if you do the numbers and you're in the example, I kept it pretty simple. We have $1,200 as the annual tax, and it's closing August 31st. So we've got a full 8 months worth of taxes at $100 per month. That's going to be $800, and we charge the seller because they're unpaid, and we credit the buyer so that the buyer has that money when the taxes come due in another couple of months. The loan origination fee, now we're getting into the closing costs. The loan origination fee is $700. We charge the buyer because that's a buyer's cost. The ALTA policy fee, we charge the buyer for $283. The escrow fee, we said it was split. It was $304, so we charge each party $152. The owner's policy, well, the question said that the seller was going to charge or be charged for the owner's policy, so we charged the seller $648. And the commission was a 6.1% commission paid for by the seller on the $100,000 sales price. That's a charge of $6,100. So now we add up all four of the columns. We subtotal the columns. So the debit to the buyer is $101,135, and the credits to the buyer are $85,800. The debits to the seller are $57,700, and the credit to the seller is the purchase or sales price of $100,000. Now, what I want you to realize is below the subtotal line, below that subtotal line, the credits and debits no longer apply. So watch what's happening here. What we're going to do is we're going to subtract the buyer's credits from the buyer's charges, and that tells us the cash due from the buyer is $15,335. Remember, below the subtotal line, the credits and debits, we put that in the credit column of the buyer only because the $85 and the $1535 total the amount of the total debits to the buyer. Similarly, on the seller side, we subtract the seller's debits from the credit, and we get $42,300 cash due to the seller. So at closing, the buyer is going to have to bring in $15,335, and the seller is going to take home $42,300. Now that's an example of a rather straightforward but not unusual closing statement that you might see in a real estate transaction. Now I want you to take some time and do two closing statement problems on your own. The first one, a property sells for $100,000. The buyer assumes the seller's mortgage of $54,000 and receives a second deed of trust for $20,000. The sales contract states that the assumed loan amount is approximate and any difference must be paid in cash at closing. The buyer's closing costs are $1,800 and the loan amount at the close of escrow is $53,700. How much must the buyer bring to closing? We have some multiple choice answers here for you. Take a minute or two and do that problem on your own. All right, so now let's look at the answer to that problem. And what you want to do is you want to set up like a mini closing statement here. And since we're really only focusing on the buyer side, how much must the buyer bring to closing, we're not going to deal with the seller side of the closing statement. So we have a debit or a charge section for the buyer and a credit section. So let's look at the sales price, $100,000. That's going to be a charge to the buyer. The buyer is going to assume the seller's loan, which is $53,700, so that's a credit to the buyer. Remember, an assumption of a loan is basically the same as a new loan to the buyer. Any loans that the buyer is taking on are always a credit to the buyer. Why? Because it will reduce the cash the buyer needs to bring to the closing table. Also, the seller carryback, the second deed of trust, is $20,000, again a credit to the buyer. The buyer has closing costs of $1,800, so that's a charge to the buyer. So our subtotals then are $101,800 as a charge to the buyer and $73,700 as a credit to the buyer. We want to know how much the buyer has to bring to closing, so we subtract one from the other, and the buyer needs to bring $28,100 cash to the closing. So here's the second do-it-yourself closing problem. A buyer buys a house for a sales price of $180,000 and puts down $5,000 earnest money. Later, the buyer puts down an additional $20,000 in earnest money and takes a $100,000 mortgage on the property and gives the seller a $50,000 carryback. The salesperson is earning a 6% commission on the property. What must the buyer bring to closing? And again, some multiple choice answers here. So again, let's set up a little mini closing statement like we did in the previous problem. So our sales price is going to be a charge, a debit to the buyer of $180,000. We're going to credit the buyer with the $5,000 earnest money. The buyer puts in, prior to closing, an additional $20,000, so that also is a credit to the buyer. There's a first mortgage that the buyer is putting on the property of $100,000. Remember, new loans are always a credit to the buyer. The seller carryback of $50,000 on the buyer side is always a credit. It's a new loan. So the subtotals then are a charge of $180,000 to the buyer and credits of $175,000. So how much does the buyer need to bring to closing? The buyer needs to bring $5,000 cash to the closing. Now remember, after closing, the buyer is going to be making payments on the first mortgage of $100,000 and payments to the seller on the $50,000 seller carryback. But again, the closing statement is always focusing on what does the buyer need to bring to the closing and what will the seller take home from the closing.